Asseto and Pharos are trying to solve a boring but critical problem in tokenized assets, moving value across chains without killing liquidity. The pressure point is simple. Asseto and Pharos want tokenized assets to move across chains with less friction. Asseto Finance Partners is the search phrase, but the valuable detail is how infrastructure, access, or execution changes after this headline. The tension here is simple. The loudest claim is not always the part with the strongest proof. Asseto Finance announced a partnership with Pharos Network, an EVM-compatible Layer 1 built around real-world assets and cross-chain liquidity, to reduce friction for users moving tokenized assets across supported chains. That sounds technical, but the whole point is simple. Tokenized assets are less useful if they cannot move where liquidity or yield actually sits. That gives the story a hard anchor before sentiment starts doing the storytelling. Asseto says several of its products are set to move to Pharos ahead of the network's planned Q3 2026 mainnet launch, with the goal of offering institutional-grade RWA yield directly through the platform. In easy English, tokenization turns an off-chain asset claim into a digital unit, but settlement and bridge design still decide whether that unit can be used efficiently. This is where structure matters more than surface excitement. For people typing Asseto Finance Partners, the next useful step is to separate what is already operating from what is only being promised. The idea is to let investors use tokenized commodities, real estate, and similar assets in DeFi strategies while relying on Pharos for scalable settlement and easier movement across multiple EVM environments. That detail is often where the risk moves from theory into actual exposure. The mechanism is not just tokenization. Tokenized assets already exist. The challenge is usable liquidity. If an asset cannot settle cleanly or move where demand sits, then the token is technically on-chain but still operationally trapped. For people searching KW, the real test is not the partnership headline. It is whether real investors can move capital with less friction after the integration goes live. Once that mechanism is visible, the pricing story gets easier to read. That matters because RWA projects are now competing on more than yield. They also need compliant access, settlement speed, collateral flexibility, and enough chain connectivity that an investor can actually do something with the asset after minting it. Cross-chain access only matters if it comes with enough depth, compliance clarity, and speed that institutions can rely on it. This is why users, traders, and treasury desks can react very differently to the same headline. What remains unclear is how much real volume these products will attract after launch, how broad the supported chain list will be at day one, and whether compliance-first infrastructure slows down the user experience or strengthens confidence. The next real proof is mainnet execution. Watch whether Asseto products actually migrate to Pharos in Q3, whether cross-chain liquidity arrives with measurable depth, and whether institutional users treat the platform as a practical gateway or just another pilot. The uncertainty is part of the valuation, not a side note after it. That leaves Asseto Finance Partners waiting for follow-through, because infrastructure only matters once users, institutions, or customers actually rely on it. If tokenized assets are supposed to work like real financial building blocks, then cross-chain usability has to stop being a brochure line and start being a measurable operating reality. Once the noise is stripped away, follow-through is the only thing that can confirm the pitch.